Ladies and gentlemen, welcome back to another episode of Investing for the Common Man. My name is Luke, and I'm here to help you save not only your money, but more importantly, your valuable time with short, concise, instructional videos. Have you ever wondered why Amazon stock trades for around $1,900 a share, and Microsoft only trades for $150 a share? Well, today we are going to break down the main factors that determine the price of a stock, as well as the reasons those values fluctuate on a daily basis. Before we start, please take 2 seconds to subscribe and hit that like button. Alright, let's dive in. When it comes to the price of a stock, or really the price of anything in a free market economy, people will tell you that it all comes down to one thing: supply and demand. While this is true, it's really far too vague for me and not helpful to your investments, so let's dig a little deeper. If you are watching this video, you probably already understand that when you purchase shares of stock, you become a partial owner of that company. Becoming an owner of a company is enticing because you are not required to do any work for the company, but you are entitled to a portion of that company's profits, also referred to as free cash flow. Since one share of stock represents a defined percentage of ownership in a company, the value of that share of stock is directly related to the total value of that company. You can calculate the total market value of a company by multiplying the share price by the number of issued shares. Now, there's no standard number of shares a company can issue, so this ends up being one of the biggest factors that causes the share prices of different companies to vary so wildly. As you can see here, Microsoft is worth more than Amazon as a company, but has also issued over 15 times more shares, so the value of a single share is much lower. Theoretically, the intrinsic value of a company is based on its future profits, but without a time machine, it is impossible to know exactly how much money any specific company will make. So to get an idea of what a company might be worth, investors analyze fundamental data from the company's financial statements. Fundamentals include things like revenue, operating expenses, debt load, earnings track record, price to earnings ratio, and more. This data can give investors an idea of what a company might be worth, but companies only publish new financial data once every quarter, so the market is always hungry for estimates and forecasts of future data points. Fundamentals are very significant and lay the foundation for stock prices, but there are several other factors that can cause a company to trade well above or below values implied by fundamental data. The next biggest factor is growth potential. This is where we start asking questions about a company's product and if there's room for existing public demand for that product to increase. To get a sense of growth potential, investors look at things like product quality, competition, market saturation, and branding. If a company is innovating a new, high-quality product on a level where there's little to no competition, then their company growth could be set to explode. Let's take Tesla, for example. Just a few months ago, Tesla almost tripled in value because they were creating an electric car with superior performance, quality, software, and cutting-edge technology for a lower relative cost than any of their competitors. Tesla also proved for the first time that it could reliably turn a profit. Simultaneously, the consumer demand for electric cars started growing rapidly due to environmental concerns and lower operational costs. So over the course of a few months, the share price tripled, not because their revenue tripled, but because the market became convinced that Tesla was uniquely positioned for exponential future growth. Let's do one more example. This time let's talk about the restaurant industry, a market that is already completely saturated. What I mean by that is there are restaurants everywhere in America, so the question becomes less about untapped markets and more about market share. Market share is the percentage of customer activity in a particular industry that a company can control. A restaurant chain can increase their market share by improving their brand recognition, public perception, or by expanding the number of restaurants in new areas to take business from competitors. A company like Subway that has already oversaturated the country with its number of locations down to 24,000 from 27,000 a few years ago does not have very good growth potential. Conversely, a company like Chipotle that has been increasing its number of locations each year and only has about 2,600 locations in the United States is likely poised much better for potential growth. Growth potential is a very real factor in company valuations, but like many marketplace metrics, it can be quite subjective depending on your outlook and perspective. News and public opinion can also be large factors that affect stock prices. If news breaks that a company is the subject of a class action lawsuit, the shares of that company are likely to take a hit due to concerns about legal fees or corporate malpractice. These days, sometimes even tweets from CEOs and politicians can cause stocks to either pop or tumble. This is where we can start to understand how supply and demand drive trading on a daily basis. The stock exchange is really just one big marketplace where buyers and sellers meet to negotiate fair prices on commodities. One vendor might be trying to sell his mangoes for $5 a piece, but as soon as another vendor offers his at $4, all the buyers will flock to the new vendor. But if there are enough buyers, the people willing to take less profit on their mangoes will start to run low on supply, and the buyers will start buying mangoes at higher and higher prices. In the digital age, this effect is multiplied 1,000-fold by the lightning-fast speed of electronic trading as millions of buyers and sellers submit bids and asks until they reach an agreement and a transaction occurs. If favorable news comes out about a company, buying pressure and demand increase, causing the price to rise. And the opposite goes for selling pressure. Sometimes a crash can occur when catastrophic news breaks and everyone tries to sell out of a stock at once. With too many sellers and very few buyers, prices will plummet 25, 50, or even 75% to attract buyers to satisfy the selling pressure. Just the other day, it was uncovered that one of Starbucks' competitors in China, called Luckin Coffee, had been caught fabricating hundreds of millions in sales numbers. Overnight, the Luckin name turned toxic, and the stock plummeted 75% in one day. The last factor that can affect stock prices is overall market trends. No company exists in a vacuum, so shifts in the overall market can affect the price action of individual stocks. During a time of market growth and expansion, investors might favor growth stocks in the technology or consumer discretionary spending industries. But in a time of economic recession, investors might look to companies with more reliable income, like utilities and consumer staples. These fluctuations do not have to rely on news events affecting a specific company. Often you will see the stocks of companies that are competitors rally simultaneously because demand for their industry as a whole is increasing. So just to recap, stock prices are determined by supply and demand, which is affected by a combination of company fundamentals, growth potential, news stories, public opinion, and general market trends. Next week, we are going to build on these concepts and learn how to pick winning stocks to add to your portfolio. So don't forget to subscribe so that you don't miss it. If you're looking to open a new brokerage account, I'd recommend that you try out WeBull. I really like their platform, and if you use my link in the description below, you can receive 2 free random stocks, one of which could be valued anywhere between $1,200 and $1,400. Until next time, keep calm, stay healthy, and happy trading.